South Africa is heading towards a debt bubble, with many consumers spending most of their disposable income to service debt. The National Credit Regulator's second quarter credit bureau monitor has revealed that consumers have debt amounting to 1.9 trillion rand as of June 2019, and experts believe that some of this debt has been offered recklessly without assessing consumers' level of indebtedness.
Many consumers are battling to cope with the high cost of living. Soaring electricity, water, food and transport costs are adding to the burden. Credit providers are capitalizing on this by offering them credit that they cannot afford. Some consumers see this as a quick fix to deal with their financial problems and do not scrutinize the interest they are being charged. There are about 25.10 million credit active consumers, and about 10.23 million consumers have impaired records, meaning they are 3 months in arrears with their repayments.
There's no question that those consumers are living beyond their means, and there's a natural belief that if I'm in financial trouble, one additional loan will solve my problems. And that it's in many cases is marketed that. So it's too easy to get more money. Instead of facing the problem, they're actually funding the debt with more debt. And that's at the core of the problem. And then they end up with a position where they run out of options in terms of debt. They actually take long-term loans. If those are declined, they go to the shorter-term loan companies and they get them approved. And they end up with a cash flow problem that they can't solve.
According to recent research conducted by financial services company Octagen, consumers spend about 63% of their after-tax income to service debt and spend only 5% on financial services such as insurance and medical aid. 32% of their income goes to household expenditure such as groceries and transport.
The cost of living has increased, and it's still increasing every day. We can just think about the petrol price, the electricity prices increases, food prices is increasing. So there's a cost pressure element that the consumers have to face. And then there's this existing debt pressure that they have. Now, if you already committed 63% of your income to debt, you don't have much to play with. And we're certainly seeing there's an increased number of consumers that will end up in trouble. And some of them actually resigned to get their hands on their pension fund, and that's not a good thing. And two, I think we're probably heading for a debt bubble like we had many years ago, where there's simply too much debt with a certain sector of the economy.
Easy access to credit is leading to many consumers taking on more credit than they can afford. This is contributing to the high levels of indebtedness among consumers. Consumers currently spend about 75% of their annual income to service debt. Octagen says it has seen an increase in the number of people applying for debt review. A debt counselor can negotiate a better interest rate for you with your credit providers, but you cannot take on more credit when you are under debt review. Slot says some of the credit offered to consumers is reckless.
Reckless credit has not been pursued for many years. In terms of the National Credit Amendment Act, it's compulsory to actually do it, and we're certainly seeing a lot of improvement in the compliance monitoring of reckless credit. We have seen in order to be reckless, for something to be reckless, there must be proof of income. There must, number two, is that they have to prevent reckless credit by making sure that the consumer can afford it, and then they do the affordability assessment. We see fairly high compliance in proof of payment, but we see low compliance in the ability to check for can they actually really afford it? Is it realistic? Can that family actually support that payment? And that's where I think we're getting a lot of credit providers who actually accept that the money has been approved not in line with the National Credit Act.
I'd like to hear your views on this topic. My email address is mulifint@sabc.co.za. My Twitter handle is @mulifinaledi.
So let's get more on the story. I'm joined by Nwako Mabeba, who's the Manager of Statistics and Research at the NCR. Thanks so much for your time on SABC News. So that total value of new credit granted increased by 5.36%. Talk to us about what's happening there.
Thank you very much, Zinga. We've seen a spike of 5% for the quarter ended June. And I think the majority still goes to your mortgages and unsecured. However, I think the concern is on the unsecured credit, which is essentially your personal loans. We've seen them actually spiking, increasing in the last few quarters. The same applies to credit facility. So that's not credit for asset building, and I think that's where the regulator is really concerned. But overall, South Africans are accessing credit worth 45 billion per month, because we've seen for the quarter ended June, 134 was actually extended. So I think the worrying trend is actually on the unsecured kind of credit that is actually being extended. But our mandate also makes provision that we need to make sure that credit is accessed, but in a responsible way. That is why I think we've actually implemented affordability regulations that are actually making sure that credit extension is tighter.
Do we see a correlation between difficult economic times and a spiking of those kind of loans that you're worried about?
Indeed. It's no secret that we've actually seen retrenchments in a number of sectors, and that has come through in the NPLs, the loans that are not actually performing well. If you look at unsecured, in spite of the spikes, it's still not doing good in terms of payment. I think the same applies to short-term credit and credit facilities. So that's where we're actually zooming in to actually see if there are areas of non-compliance.
Okay. Let's break down that granting of credit, because those numbers are quite big, but the majority of credit is granted by banks. They granted 107 billion rand for that period. And then next up was the retailers with 5.64 billion rand, and the rest is made up of non-bank financiers and other credit providers at around 11 billion.
That is correct. Quite naturally, the banks are the biggest, I would say, credit providers. So I think it is to be expected that they would be the largest. And you also have your vehicle financiers that are actually entering into the space. They have their own books. You have, I would say, you're on a non-bank, you have things like your insurers that are also, I would say, granting credit as well. So they'll be classified as such.
Okay. I thought the mortgage trends were quite interesting. Mortgages, granting of mortgages increased by 14.31%. What trends are we seeing in terms of the cost of houses that are being granted mortgages and the salaries of those who are being granted mortgages?
I think the unfortunate part is that the majority of granting is for consumers that are on the higher end in terms of earnings. But we are concerned, in spite of the recent increase that we've seen for the quarter ended June. Mortgages used to be 60% of all credit extension. It's now reduced to below 30%, and you're having a situation where South Africans are actually applying more for vehicle finance as opposed to mortgages, which is, I think, it's a real concern, taking into account our history where there's a shortage of housing. We're not saying it's bad, but we would rather consumers were actually applying for mortgages as opposed to vehicle finance. So I think it's a concern, especially because the lower end is not growing as much. I'm talking about your consumers earning 7,500 and less. You're seeing an increase in the higher end, consumers earning at least 15,000. That's where you're seeing credit extension actually, I would say, increasing.
Okay. Then there's a development credit where people are trying to, I'm assuming, better themselves and better their lives. What is that sector looking like?
Developmental credit is largely very cyclical. The majority of it is student loans. And we normally see the spike in the first quarter, which is January, when students are being financed. But it stopped drastically because I think the main, I would say, grantor, which was NSFAS, has actually changed their model. So as a result, we've seen a very significant drop in this sector. But we've been engaging banks, because even banks do extend this kind of credit, to actually classify it, I would say, correctly, because you'd find banks extending personal loans that are essentially for purposes of study, but they're not classified as developmental. So even the DTI was concerned. They've actually commissioned a study relating to this for the banks to actually do the right classification, banks and other credit providers as well. So I think the drop, or the drastic drop, is largely to the change in model relating to NSFAS.
Okay. There's a concern that South Africans are using around 75% of their annual salaries in order to just service debt. And as a regulator, one of the things you try and do is also talk about the behavior and how to work with credit in a way that is not detrimental to you. So what behaviors or what advice would you give to our viewers now who are servicing debt with that around?
There's no magic bullet. If consumers enter into credit, they must honor their obligation. And every credit that you actually acquire is going to come with associated cost. You have got initiation cost, you have got credit life, you've got, there's quite a lot of, I would say, cost associated with credit. Make sure that you can afford it. Make sure that it fits within your budget. If you've drawn up a budget, make sure that you look for the variances.
Thanks so much for your time. Mwako Mabeba, who's the Manager of Statistics and Research at the National Credit Regulator.